January 2021. Millions of people are glued to their screens. The price of GameStop is exploding, from a forgotten retail stock to a Wall Street earthquake. Reddit forums are on fire, hedge funds are panicking, and then something strange happens. The buy button disappears. Trading platforms freeze, investors are locked out, and just like that, the most chaotic stock surge in recent history is stopped cold. Most blamed the brokers. Some pointed at the SEC. But few noticed the quiet figure in the background, a name most have never heard, yet it sits at the very heart of the global financial system, the DTCC. Today, you'll uncover the secret mechanics behind the GameStop halt, the glitch that wasn't really a glitch, the emergency protocol activated deep within Wall Street's infrastructure, and the billion-dollar pressure no one saw coming. Because when a crowd of everyday investors backed the system into a corner, something or someone pulled the plug. It started like a joke, a random Reddit post, a meme about a dying video game retailer, a screenshot of a trade, not a recommendation, not financial advice, just one user saying, "I like the stock." The company was GameStop. Brick-and-mortar stores, outdated inventory, losses piling up quarter after quarter. Wall Street had already written its obituary. Hedge funds were shorting it into oblivion, betting billions that it would go to zero. But deep inside the forum, Wall Street bets, a strange energy was building. It wasn't just about money, it was about irony, about rebellion, about flipping the script on the people who always seemed untouchable. And then, something clicked. One by one, small investors started buying, not just shares, options, high-risk, high-leverage plays designed to force a reaction in the system. And the system reacted. GameStop stock didn't climb, it launched. $20 became $40, then $100, then $200. Trading volume surged into the billions, and behind every candle on that chart was someone with a smartphone, a grudge, and a belief. We can break them. Hedge funds began bleeding. Melvin Capital lost 30% in a matter of days. Billions evaporated. CNBC hosts shouted over each other. Every hour brought new chaos. And the crowd? They weren't done. They called it a gamma squeeze. The more the stock rose, the more market makers had to buy to hedge the risk. A feedback loop was forming. Reddit was no longer just a forum. It was a force of nature. Mainstream media tried to catch up. Headlines called it a war, a revolution, a bubble. But none of them saw what was happening under the surface. Because while the price soared, another number was climbing too, quietly, invisibly. Risk exposure. The trades weren't settling instantly. Clearinghouses, the financial middlemen who guarantee that stock transactions actually happen, were watching liabilities stack up at terrifying speed. Every new GameStop share bought added pressure to the system's plumbing, but the retail crowd had no idea. To them, it was just fun. January 27th, GameStop hits $347. January 28th, pre-market, it touches $483. And then, everything stops. Robinhood freezes buying. So do other brokers. You can sell, but not buy. Panic, outrage, betrayal. Reddit explodes with fury. Memes turn into accusations. The question ricochets across the internet. Who shut this down? Robinhood blames capital requirements. But whose requirements? Who demanded billions in the middle of the night? And why was the buy button the one that vanished? The answer, as it turns out, wasn't in the news. It was buried in a name barely anyone recognized. A name printed quietly on nearly every trade confirmation slip in America. DTCC. 4 letters. Barely mentioned in headlines, rarely explained on TV, and yet, in that crucial moment, they were the ones who made the call. But let's not jump ahead. January 28th, the price of GameStop opens at nearly $500. Retail investors are euphoric. Memes are turning into mortgage payments. The movement feels unstoppable. And then, with no warning, Robinhood flips a switch. A message appears on screens across the country. Buying of GME is temporarily disabled. No explanation, no countdown, just silence and then chaos. Twitter melts down. Discord servers crash. Reddit enters meltdown mode. Some think it's a glitch. Others scream market manipulation. But something deeper is happening. The trades didn't stop because of a bug. They stopped because Robinhood received a call, not from the White House, not from hedge funds, from the NSCC, a division of the DTCC. In less than 24 hours, Robinhood's capital requirement, the amount of money they needed to hold to process trades, had ballooned from $124 million to nearly $3 billion. That's a 24x increase overnight. Robinhood didn't have the money. Most brokers didn't. And so the NSCC, citing volatility risk, made an ultimatum: raise the capital or stop the buying. Robinhood CEO Vlad Tenev would later claim they had no choice, that the decision wasn't political, wasn't pressure from Wall Street, but rather a raw mechanical constraint imposed by the system's core infrastructure. But here's the question no one could answer. Why only restrict buying? Why could investors sell GameStop but not buy more? Because from a clearing perspective, buying adds liability, selling reduces it. And the DTCC was no longer thinking like a neutral party. It was thinking like a firewall. Every new buy order was another load-bearing brick on an already cracking foundation. So the NSCC, behind closed doors, hit pause. Not on Wall Street, on you, the people. No courtroom, no legislation, no headlines. Just a back-end switch flipped inside a clearinghouse, and suddenly a retail rebellion was frozen mid-flight. It wasn't a market crash. It wasn't a sell-off. It was something far stranger. A system deciding what trades were too dangerous to allow. And while most were busy shouting at Robinhood, few realized the decision had come from higher up, from deeper inside the financial machine, from a place where you don't see hands, just levers. But what kind of institution has that kind of power? And who gave it the authority to stop the market? The name was out, but the structure behind it was still invisible. And that's where the story goes next. Everyone saw the freeze, but almost no one saw why it happened. Behind the shutdown, beneath the outrage, there was something far less visible, but far more dangerous. A margin call of historic proportions. Robinhood, the app that branded itself as for the people, wasn't being heroic. It was hemorrhaging, not in the headlines, in the balance sheet. Because every time a user bought GameStop, that trade didn't settle immediately. It had to go through a clearing process. And that's where the NSCC, the National Securities Clearing Corporation, a critical division of the DTCC, came in. The NSCC acts like a financial referee. It ensures that when one party buys and another sells, the money and shares actually get where they're supposed to go. But when the market becomes volatile, when trades involve massive leverage, thin liquidity, and meme-fueled momentum, the NSCC doesn't just watch, it intervenes by demanding collateral. This is called a margin requirement, a kind of security deposit that brokers must post to ensure they can honor their trades. When risk spikes, margin spikes with it. And on the morning of January 28th, Robinhood got hit with one of the largest intraday demands in recent financial history: $3 billion. That number wasn't just a technical adjustment. It was a message: slow down or collapse. Robinhood didn't have it. At the time, the company had raised less than $1 billion in total. Their liquidity couldn't match the scale of the retail uprising they had helped ignite. So what did they do? They stopped the buys and quietly negotiated with the NSCC to reduce the collateral. Eventually, after slashing trade volume and halting certain stocks, the requirement was brought down to $700 million, an amount Robinhood could just barely cover with emergency funding. Vlad Tenev would later testify that the platform was hours away from a full-blown default. Not a glitch, not a protest, a total failure to meet clearing obligations. But here's what made this moment so chilling. None of this was public at the time. No press release, no alert, no transparency. An opaque institution, hidden in the engine room of Wall Street, issued a capital call that nearly froze the most used trading app in America. And in doing so, it flipped the script. Suddenly, this wasn't just about Reddit versus hedge funds. It was about something far more structural. How fragile the system actually is when retail pushes back. Because if Robinhood couldn't cover its trades, what about other brokers? What about the clearinghouses themselves? How close did the system come to buckling? And more importantly, what else can the DTCC do when things get out of control? The next chapter would show that this wasn't the first time they intervened, but it was the first time they intervened against the public. Up until now, the name DTCC had barely made a sound. No public statements, no press briefings, no camera time. And yet, every investor who had ever bought or sold a U.S. stock had already interacted with them without knowing it. Because the DTCC isn't a company in the traditional sense. It's more like infrastructure, the plumbing of Wall Street. And when that plumbing fails, nothing flows. Here's how it works. Every time a trade happens, whether you're buying 1 share of GameStop or 1,000 shares of Apple, it doesn't settle instantly. It passes through a clearing process. That's where the DTCC comes in. More specifically, through its subsidiaries, NSCC for stocks and DTC for custody. They handle all of it: trades, settlements, custody, records. Billions of transactions per day. In total, the DTCC processes over $2 quadrillion worth of trades per year. That's not a typo. $2 quadrillion. More than the GDP of every country on Earth combined. But despite this enormous scale, the DTCC is not a household name. It's never meant to be. Its power lies in its invisibility. Because the moment people start asking who actually owns your shares, they might stumble on something deeper. Here's the twist. When you buy a stock on your broker app, you don't technically own the shares. The DTC, a DTCC subsidiary, becomes the registered owner. Your broker has a claim on those shares, and you have a claim on your broker. In other words, there are layers between you and what you think is yours. This matters, especially when markets shake, because it means that during times of extreme volatility, you are the last in line. And the DTCC, quietly and legally, can override trades, demand instant collateral, or even pause clearing altogether, all without your knowledge. It's called systemic risk mitigation. But during the GameStop saga, that mitigation wasn't aimed at banks. It wasn't aimed at hedge funds. It was aimed at you. Retail traders, millions of them, became the risk factor. And the DTCC moved to contain them, not with warnings, not with regulations, but with back-end force. They pulled liquidity, raised collateral, pressured brokers, and when that wasn't enough, the buy button vanished. For decades, the DTCC operated in obscurity. But in January 2021, for a brief moment, the curtain was pulled back. And what we saw was something far more powerful than any hedge fund or broker. A system with the power to intervene without asking permission. But it begs a bigger question. If the DTCC has this kind of emergency authority, what exactly is their limit? And more importantly, do they have an off switch? Throughout the chaos, one word kept coming up: volatility. It was the excuse given for the freeze, the reason margin requirements spiked, the justification for limiting what millions could buy. But volatility in itself doesn't shut down markets. Something else did. Buried deep inside the DTCC's operational playbook is a protocol that almost no retail investor has ever heard of, and yet it may have been the most powerful force during the GameStop saga. It's called NSCC Rule 801. On paper, it sounds technical, boring, bureaucratic, but in practice, it's the kill switch. Rule 801 gives the NSCC the right to impose extraordinary measures when the stability of the clearing system is at risk. That includes raising margin requirements instantly, suspending the processing of certain trades, or even cutting off clearing entirely. It's not a suggestion. It's not subject to public approval. It's not even something brokers can meaningfully contest. It's an emergency lever created for moments of crisis. 2008, for instance, flash crashes, black swans, and in January 2021, GameStop. Sources close to the matter later confirmed the DTCC activated Rule 801 to demand billions in collateral from clearing members, including Robinhood. This wasn't just routine risk management. It was a direct, calculated intervention to stop a movement they deemed too dangerous. And here's the part few realize. The DTCC doesn't need your consent to do this. It operates in a quasi-private capacity. It's owned by the same financial institutions it oversees, and while it reports to regulators, it has vast discretion in how and when to act. Which means that in moments of extreme pressure, the market isn't governed by supply and demand, it's governed by risk optics. And when the risk doesn't come from banks or funds, but from the crowd, the system treats that threat just the same, maybe worse. Because a failing hedge fund can be rescued, but 1 million angry investors can't be controlled. So the DTCC didn't shut down the GameStop surge by banning it outright. They didn't need to. They used infrastructure, margin, time, liquidity. And in doing so, they reminded the world of a quiet, chilling truth. Markets are free until they aren't. Because when everyday investors pushed too hard, too fast, and too close to the limits, someone, somewhere, pulled the emergency brake. And that someone wasn't a CEO, wasn't a politician. It was a system most people didn't even know existed. It wasn't about GameStop. It was never just about a stock. It was about the illusion of control and what happens when the crowd dares to test the rules of a game they were never meant to win. For 1 week in January 2021, everyday people moved the markets. But when their power grew too loud, too visible, and too real, the system didn't crash. It adjusted. Silently, surgically, without headlines. And behind that adjustment stood a name most will never remember, but that touched every single trade. DTCC, a shadow institution, invisible until it wasn't. So next time someone tells you the market is fair or open to all, ask them who owns the off switch. And if this story revealed something you weren't supposed to see, imagine what else is still buried. If you made it this far, you're not just watching, you're waking up. Subscribe to Bull Secrets, leave a like, and share this with someone who still thinks the market is free. Because the more people know how the game is really played, the harder it becomes to rig it.